Hi friends! In the comments of one of my videos I was asked which option strategy do I prefer. In the comments I answered that it's probably a ratio spread. Why? Because they're very good to manage. But this is my personal opinion and everyone has their own. But I would like to emphasize that I do indeed prefer ratio spreads for active trading. And in this video I will try to tell you in detail why. Let's imagine a situation. Bitcoin has grown and I expect further growth. In this case I need to have some positive delta. But at the same time I do not expect Bitcoin to grow highly and beyond the limits. I expect it to grow somewhere around level 35. I built this ratio spread with put options. I bought 1,000 options with a strike of 34,500 and sold 2,000 options with a strike of 34,000. Always, when creating a strategy, we look at the maximum risk. In this case, it is 1 Bitcoin. I plan to actively manage the strategy. The break-even point in this strategy is 33,000, and if we do nothing and the price falls below the level, we will get Bitcoin for 33,000. The maximum profit, $1,000, we will get if the price reaches the 34,000. We should not count on this. But I expect to get this one, $500 ratio spread credit. Note that the expiration of these options is in a week. What kind of profit does this ratio spread have? I'm not talking about the peak, but about the fact that the price will be fixed at one level and will not go down too much. This profit is $500. Margin requirements are somewhere around $5,500. For 1 week, I think it's a good return. But if I am not ready to get Bitcoin for $33,000 and I want to manage the strategy in case the price falls, I have several options. Let's say the following happens. Bitcoin falls and after a few days, its price drops to the 33,700 level. My sold put options go into the money. In this case, I can apply rolling. I buy back some of the put options I sold. I have now added a new asset and prices are back to default online values. But I am modeling offline, so I will need to adjust the values later. I buy back 1,000 put options and sell options of the next strike, 33,500. Give me a few seconds, I'll correct the prices and put the date back in. Oops, I added the wrong asset. I'll have to fix that too. And now look at what I've got. We are right here. I didn't use any ratios, and I could compensate for the loss in delta with the time premium of the 33,500 options. But I'm just doing a simple demonstration right now. My break-even point is now at 32,700, and the profit cap is now wider. So, what do I do next if the downward move continues? I can continue to roll, and this leverage of 33,500 I can carry over to the next strike. For example, 33,000. The cap will get wider, the break-even point will move on and on. What will I get in the worst-case scenario? I will get Bitcoin at an interesting price. This ratio spread management technique allows us to keep not only the original credit, but to be under a profit cap twice as great as the original credit. In addition to delta risk, we have a vega risk, where we take an additional loss when volatility rises. But on the other hand, there's an upside to this. Because by selling the following options, they are more expensive due to the IV. Our time premium increases in the end. But the main thing is to survive until expiration. You need to make all calculations correctly. You need a trading plan where all roles are calculated and margin requirements are taken into account. So don't forget to click on the GM button to update the margin requirements. The main risk of this strategy is that we may get a margin call, in case we don't have enough money to fund the trading account. We're selling more and more put options, and therefore we may not have enough money for margin requirements. Therefore, you should enter this strategy when the margin requirements are 25% of your trading account. And of course, it's not necessary to use only ratio put spreads. You can use ratio call spreads, but it depends on you and your price scenarios. The market will settle things, and this strategy still leaves a chance to make a profit even in the worst case scenario. And that's all I wanted to tell you about my most preferred strategy. As always, ask questions in the comments. If this video was useful to you, put a like and subscribe to the channel. I wish you good luck and successful options trading.